Do you know the differences between a standard home equity line of credit and a HECM line of credit? My name is Trevor Carlson. I'm the president of Heritage Reverse Mortgage. I'm going to walk you through the differences of these two options when it comes to accessing the equity in your home and what might be better for you. And so the first one we want to talk about is the standard home equity line of credit. If you're not familiar with this is a very common way for you to go to the bank, set up a line of credit against the equity in your home, and the bank gives you an open account of money that you can actually borrow against your home. Now, the pros of these lines of credit is that typically the closing costs for these loans are very reasonable. You can get it done very quickly. The downsides to a home equity line of credit is it has a payment. And so if you start borrowing money against the equity in your home, you need to be careful because the payment is going to grow with the amount of money that you borrow. Very similar to how a credit card works. The other issue with home equity lines of credit is that the interest rate is generally adjustable, which isn't great, especially because of that growing payment you have every month. And likewise, one thing that I really hate about these loans that we saw a lot of back in 2010 during the big Great Recession, when home values were coming down, banks have the right to freeze that line of credit. So you might have $100,000 in your line of credit today, but if your home value starts to slide, your bank could freeze all of that and say, nope, sorry, you can't take any of this. And so that's why I'm not a huge fan of the HELOC, especially for retirees who I normally serve in my career. The HECM line of credit is the alternative that we generally will show people. The nice thing about the HECM line of credit is it's very similar in that you set up a line of credit, an open account, where you can draw money from the equity in your home. But the primary differences of the HECM are that there are no required monthly mortgage payments. As long as you live in the home and you pay your property expenses like taxes and insurance, you can draw this money out, either in fixed monthly payments or you can draw it out voluntarily, $1,000 here, $10,000 there, whatever it is you need. And so you can use this money from your equity line of credit, but it doesn't impact your income because it's not raising your expenses with the monthly payment. If you want to pay the money back, absolutely go ahead and do that, but you don't have that requirement. And that helps to make life a lot easier and better for people on a fixed monthly income once they enter retirement. Now, the downsides of the HECM, of course, is the closing costs are going to be higher than a standard HELOC. The time frame generally takes about 3 to 4 weeks to close a loan versus 2 to 3 weeks with the HELOC, and so a little bit slower, not much, but a little bit. But the nice thing again about the HECM is that this is something that will last for you as long as you're in this home. And so again, you're paying your expenses, you're living in the home. This loan can last until age 150, and you can borrow that money as you need it. Likewise, it's non-taxable. And so if you need a lot of money for a surgery or a trip or whatever, that's great. Go ahead and take it. The IRS isn't going to penalize you for using the equity that's in your home because they don't consider that as income. And so I hope this helps to clarify. Again, there are a lot of differences and nuances that we may want to dig into deeper if you're considering one over the other. But if I can answer questions for you or somebody that you care about, please give me a call. We'd be happy to help. My number is 435-359-9000, and my email address is trevor@heritagehl.com. Thanks for watching. Hopefully we'll talk to you soon.